have two daughters. They're 9 and 12 years old. I am a Los Angeles native. I grew up in Inglewood. I always went to school at LAUSD. So like I went to Windsor Hills for elementary, then Palms and King Drew for high school. I did graduate from University of California, Irvine. And I lived out there for like 6 years. So I'm familiar with Los Angeles all over, as well as Orange County, if anybody is thinking about those areas. My husband and I, we bought my current home. We bought our first home. It'll be 6 years this month, actually. So I am a person that I do help people reach their real estate goals, but I also am a homeowner myself. We've done renovations, so I've experienced all that and all the emotions that come with it. So what else? Let's see. I love home decor, but I love good deals. So if you're ever looking for the furniture, but you're not trying to break the budget, you can reach out for those resources as well. And I also love to bake. I used to be a home baker and had that business going prior to jumping into real estate after having my second daughter. And I've been licensed for 9 years now. What else? Yeah. Oh, also keep in mind, let's say, for example, you're living in LA right now, but you might be relocating to life or jobs. I have connections, and Otis as well, have connection with agents all over. So I've had people that attended my workshops, but they purchased, what they buy? Sacramento, Cincinnati, Connecticut, Henderson, like all over. So the point is, even if you have real estate needs that are going to be out of Los Angeles, feel free to reach out. I can connect you with an agent wherever you're going. And I'm trying to think of anything else. Yeah, that's pretty much me. And then I'm going to let Otis introduce himself as well.
Good morning, everyone. Thank you, Ashley, for another workshop together. I'm super excited about this one. My name is Otis L. Milton, coined the mortgage millennial. Although I got gray hair, a lot of it, I'm still a millennial. Um, I have been in the mortgage industry for 7 years now. I've been in the real estate industry for over 12 years. I started out as a real estate agent, property manager, so I've done multiple roles within this industry. Really found my niche in the mortgages. I really am interested in the financing part of it, learning how it works, and really being a voice for a lot of people who don't have it, especially ones that look like us, in that financing world in terms of when it comes to lending. Um, African American loan officers represent less than 8% of loan officers in the country. So that was one of the real reasons why I took this charge to get that license. I didn't think I would stay here, but I ended up staying here. And I absolutely love it. A little bit about me personally. I have four daughters, one's in college. So keep me uplifted in prayer. We all need, I need each one of you guys to buy a house because tuition is hurting right now. Okay. I have one that's getting ready to go to college in a year or so, soccer star, and I have two little ones who are in elementary. So they're my absolute everything, and they keep me going. And they keep running in my pockets. So that's what girls do. I'm a girl dad, and I absolutely love it. So I've worked for multiple mortgage banks and mortgage companies. I transitioned over to be independent about 2 years ago, almost 2 years ago. Next month will be 2 years that I've been independent. Yes, I miss my cushy office in Beverly Hills, but I also like the flexibility of being able to do other things that maybe we can't do at your traditional banks. And understanding the borrowers of today aren't, the borrowers of 10 years ago, 5 years ago, 20 years ago. Not everyone has 20% down. Not everybody has an 800 credit score, but that doesn't mean they don't deserve to be serviced and have advice and experience help them along this process. So, a little bit about me. We're going to cover a lot of good stuff today. We'll talk about rates and how to qualify and all that good stuff. But that's a little bit about me. Again, like Ashley said, if you guys have any questions, please feel free, type it in the chat. If you don't want to come off mute, you can come off mute. We're going to do a little poll shortly to ask some questions to get a little bit of information about exactly who we're speaking to, so we can tailor this and talk to some specific questions that you guys may have. So back to you, Ashley. And again, I'm super excited to speak with you all today.
Yes. Okay, so why do you want to become a homeowner? This is like a little icebreaker. Everyone has their own usually reasons and motivations behind it. So why do you all want to become homeowners? Oh yeah, Otis, I cannot see some sharing screen. I can't see if anyone's in the waiting room or chat.
Yeah, I'm monitoring it.
Okay, cool. Nobody want to speak? or type
Yeah,
in chat?
I let it I let the last person in, so we're good right now.
Okay.
I'll share.
Thank you. Good
Good,
morning.
good morning. How you doing, Miss Kennedy?
Good. Ashley, no.
Sorry, I'm used to Miss Kennedy. Um, for me, I will say I'm actually torn about home ownership because the prices of homes are so high in LA. And so I'm in a space where I may have to move, and as I'm thinking about moving, I'm just opened up to to the idea of maybe buying. However, if I buy, and it's always kind of been in the back of my mind, if I do purchase,
Mhm.
I would have liked to have had a multiplex so that some rental income could help pay for the mortgage.
Mhm.
And so I'm in this process to see, is something like that viable still with the housing market? And does that make sense compared to like me renting? So just kind of open for options right now.
Okay, that's good. That's
Yeah.
awesome. And Otis can later in the presentation he can kind of dive into that a little bit. So that's awesome.
Okay.
Anybody
Yeah,
else?
and I want to say thank you too, Kara, for that honesty and transparency.
Mhm.
That's a real question, and we could address that, and
Okay.
we will throughout this. So thank you for sharing.
Good. Thank you.
Okay, well, I don't know if anyone else wants to go. I can't see the chat or who's here, but I'll just kind of keep it moving. A lot of people usually will say, if they have kids, they may want the yard, or if they're currently renting and if the owner is selling, and then, just kind of having that consistency. Um, or if their rent is getting high. So those are just kind of some common reasons that people will share. Otis is going to do a quick poll so we can just kind of learn. And don't worry, other participants, they cannot see the responses. We're going to do a quick poll so that way we can kind of get a feel for the room and we can know which topics to kind of spend more time on. So it's, how did you hear
The
about today's workshop?
Yeah,
When would
and
you like to?
I've launched them, so they should be able to see them.
Okay, cool.
I want to speak.
Mm-hmm. Good
Hi,
morning.
Ashley. Good morning. Sorry, I can't show my face. I'm like driving, but
No,
I
don't
did
worry.
want to say that I joined, of course, to support you. But for the longest, as long as I've known you in my adult years, because we attended high school together, you've been pretty consistent with this, and it's like something I admired about you. And so I just wanted to support you in that way, and also, the knowledge that I get from when I've taken your classes in the past or what you post, it inspires me because I'm like, I want some longevity for my kids, something to pass down to them and create another source of income or generational wealth. So that's why I joined today.
Thank you. I appreciate it.
I'll give one more minute for the poll, and then we'll end those.
Okay, is it what, 3 people? Okay, got it. Well, I know one person's driving, so I think we're probably done.
Okay.
Got it. Don't worry about doing this while you're driving. Okay, so okay, cool. Are you able to hit in?
I just ended it.
Okay, cool. Okay, cool. So this is fears versus fact. I always do this. So for example, the fear is I can't afford to buy a home right now. And then to that, I would say, until you speak with a lender, you don't know what you can or can't afford. A lot of times we get advice from, say, family members, and they mean well, but things have changed so much over the years in terms of what's necessary to purchase. Like, for example, I don't have 20% for a down payment. Back in the day, yes, people did need 20% to purchase a home, but that's no longer true. There's various options of low down payments being able to purchase. So, again, that's something you wouldn't know unless you're able to speak with an actual mortgage professional such as Otis. And then a lot for our generation is I should pay off student loans before purchasing. But a lot of people have, I myself still have paid off student loans. So student loan debt, it does not have to prevent you from purchasing. It may take some preparation and of course a good lender can assist you with that process, getting a manageable payment and seeing how that affects your DTI. But you can still definitely purchase a home even with student loan debt. Or I can't afford to buy my dream home. A lot of people, especially out in LA, because our home prices are so high, they feel I'm going to spend this much, then I need to absolutely love it. It needs to be perfect. When in reality, for most people, unless you make a lot of money or you're just getting some amazing gift funds, your first home, it might not be your dream home, but as long as it's something that you can see yourself in, you say, I would say, as long as you can be there for 5 years, you're able to make it your own. That will be your first step. And then you can always, get your starter home. And then once you have that equity, use that to roll over to your next purchase and then kind of move yourself up either to a larger house or go from a condo to a single family or maybe to you're going to upgrade neighborhoods. Our house, it was cool. I mean, it wasn't like cute. Like I saw the vision. My husband saw the vision. The kids are like, But yeah, it's just kind of getting your foot in the door, especially if you're somewhere like LA where, the home prices, the affordability isn't there. It's just kind of like getting something that you can, like, don't get a shack. Like, it should be decent and livable, but just get your foot in the door and then you can always, continue to, like I would say, elevate. Okay, and so these are the steps. Any questions real quick? Sorry, before I move on. Good, okay. So the 6 steps to home ownership, I would say step 1 is find yourself a knowledgeable realtor such as myself. And then your second step will be to get pre-approved by a lender. So Otis, what you would do is, and he'll dive into it later, but basically you guys are gonna have a quick phone call with him and you guys are gonna discuss things and you kind of see where you're at in the process. And then he'll send you over a mortgage application and then you'll complete that. You guys will discuss numbers. Lenders will always tell you the max you qualify for, but if you have a number in mind that you want for your monthly payment, then you can let him know that. He will kind of reverse engineer it and then let you know, okay, if you want your payment at this amount, then your maximum purchase price should be this. So once you guys discuss numbers between you and Otis, then I come in and then I'll have a buyer's consultation or like a needs analysis. And then we discuss like what you're looking for in a property, why you're looking for it. We discuss neighborhoods, if you have any lifestyle needs, pets, kids, etc., or work, like proximity and all that. So we discuss that. And then I, of course, make sure I'm only sending you properties that are going to work for you as well as within your budget, because, that's really important for us, your comfort level. And then at that point, that's when we started looking at properties and then, putting an offer. And then once accepted, then we move into escrow. And that's when you get your home inspection, the appraisal, go through all the contingencies. And then, of course, for today, I'm going to keep it pretty broad and light because I don't want to overwhelm you guys. But when that time comes, during that buyer consultation, I dive in deep. We do it via Google Meet. It's maybe an hour at the most. And I really dive in and explain what the contingencies are. We go through a sample purchase agreement, what it looks like. Like I'm really big on my clients having the knowledge, having the knowledge. And then also, like I don't make decisions for you. This is all for me. You gotta admit, okay. But yeah, we don't make decisions for you. We just kind of like, we're your guides. We share the information, our expertise, but you guys always make the decisions. So really big on that, having that education and you guys decide what you want to do. Can you admit the person I'm trying to, my screen keeps overlapping. And then
Yeah, I did already.
Okay, cool, thank you. And then at the end of all that, then you get the keys to your home and you become a homeowner. Any questions so far? Nope, okay. So, oh, go ahead, someone go ahead.
No, I was just saying no questions.
Okay. So why do you need a buyer's agent? As a buyer's agent, I educate you on the market. We analyze your needs and wants. That's what happens during the consultation or needs analysis. I will show you homes that fit your criteria. And then I coordinate the work of other professionals. So once you have opened escrow and it's time to have your home inspection, I will recommend some to you. You're always welcome to use whoever you want, but if you need referrals, I give you those referrals. Or let's say the home inspector says, hey, I suggest you get an electrician out here. I have one that you can call, plumber, roofer, whatever you need. I will make those recommendations to you. If a lot of my clients are busy working, so of course they don't have to be there. I will meet whoever it is, whatever vendor. I'll meet them there. I usually will record a video so that way they can tell them directly. You can hear it from their mouth directly what their findings are. But yeah, I assist with all of that, and then of course negotiate on your behalf. but I never make decisions for you. I collect the information, present it to you, and ask, how do you want to proceed? And then, of course, solve any problems that might arise. Usually between myself, escrow lender, like if anything pops up where you're trying to solve it before we even get to you, or have a plan B before coming to you, because it's already a stressful process. So we try to take as much of that stress off of our client's plate as possible. And then Otis, this kind of jumps on over to you.
Sorry, I was on mute. Everybody's favorite topic, right? Right, Monique? This is everybody want to talk about credit.
Always comes up.
Right? Right. It's the red-headed stepchild in the room. So, little bit about credit. Credit is kind of changing for us in the mortgage industry. Very, very, very soon. It's kind of already started to be happen. So we'll talk about some of the minimum basics, but some of these, in terms of how we look at it, may be changed, right? So have you guys ever heard of Credit Karma? Everybody heard of Credit Karma? Right? Or you might have like the credit card that gives you a credit score every month, like Credit Wise or something like that, if you have like Capital One or et cetera. Most banks do that. So those are different scoring models than a FICO score, right? So you might see a different credit score on your Credit Karma than you might see if you were to get a mortgage application or even a car, like to go purchase a vehicle. They're all different scoring models. So the score is not wrong. It's just right for that model. So if you are going to buy a house, but you're looking at your Credit Karma score, that's not going to be the same score that we look at on a FICO, right? So the big change that's happening is now they're going to be accepting Vantage scores in the mortgage industry, which is a new thing, right? So we've only been able to use FICO scores before. And so I believe beginning this month, some of the lenders are going to start to begin to accept those. So we might look at your FICO score and look at your Vantage score. If the Vantage score is better, if that report is better, then we may use that one to qualify you and submit to the lender on. So this is something that's really new. I don't even know how aware Ashley is of this. That's going to be happening in terms of credit as it pertains to the mortgage industry, right? So yeah, it's a huge good thing because Vantage scores. One good thing is this: it can't hurt, right? Because if it's worse, then we just don't use it, right? But if it's better, then it helps, right? So I don't really see a downside to it. I mean, maybe the extra $60-$50 for the credit report, but I mean, if that helps you, let's say if you have a FICO score of a 640, but you have a Vantage score of a 690, that might help you qualify for 0.5% better in interest rate, right? Which gets you lower payment, which, you know what I mean? So it's a trickle down effect in terms of how it works. There is a big difference. And the reason why there's a big difference, Helena asked a question in the chat. Is there a big difference in number in the score? Yes, because the Vantage score system, how it weighs the score is different than how FICO weighs the score. So for instance, on a FICO score, especially the one that we use, the classic 4 in mortgage industry, which is a super old model, but we're old in this industry. We don't take into account if someone has rent that they pay and they have it added to their credit report, that has no effect on a FICO score. But with the Vantage score, it does. So let's say Miss Elena has been renting somewhere for 2 years and she's added that to her credit report. On a Vantage score, that will actually increase your credit score, right? So what Vantage score weighs, FICO doesn't in some instances. So like, for instance, on a FICO score, 28% of the score is based on your credit utilization, how much of your credit you're using, right? I'm going through this right now in real time, guys. I have someone who paid off a credit card and his credit score dropped, right? And we're in escrow, and I got to figure this out, by the way. Right? He paid off a credit card. In everyone's mind, why would less debt should make me better, right? And it unfortunately doesn't work like that with credit. Credit is very algorithm based today, right? We're all familiar with the algorithm term, right? And so they want to see you manage credit, not be debt free, right? So you want to, for best practices, keep a small balance on your card. Let's give an example. Let's say you have a credit card with $1,000 limit. You maybe want to run $150, $200 balance on that card every month. Your credit score will actually increase than you paying it versus you paying it off. That sounds crazy. I know, Monique. It sounds crazy, right? It's like, well, why wouldn't you? Because they want to see people managing debt. Now, if you have $1,000 credit card limit and you have $1,000 on it every month, that's going to drop your score because that shows them you can't manage it. You have to live off of it. You're just paying the interest, right? So you're trying to show the algorithm that I know how to manage debt, not live off of it and not be debt free. Really weird, but we learn the rules to the game and then we just play it, right? So that's a little bit about credit. Some of the minimum scores, FHA has the lowest minimum score. You could do it at a 580 and still only put down 3.5%. Not recommended because the interest rate's going to be higher because it's hugely based on the credit score, but you can do it at a 580. Conventional loans, 620. Conventional has some stuff changing about credit too, but I did say the 620 score is going to be remaining. With the VA loans are a little bit different than any other type of loan, obviously, because it's for a veteran, but there's no set minimums, right? In terms of like a credit score or a debt to income ratio, it's all based on what the automated underwriting system tells us based on the veteran's application, right? So what their income is, et cetera. So there's not necessarily a minimum. Obviously, the higher, the better the interest rate, right? For down payment assistance programs, you have some starting at 640. You have some that will be at 700. It just depends on the program. But the minimum score for some of the programs are 640 if you're looking for down payment assistance or closing cost assistance. And then I put it in here. Lenders are going to be accepting VantageScore soon. So we just talked about what that looks like. For anyone that's maybe had any derogatories on your credit report, like bankruptcies, bankruptcies need to be charged off. Depending on the chapter that you file, that's something we could talk about if that pertains to you. And then collections, and people are like, oh, as soon as I pay off that JCPenney card from 2006, I'm gonna get this house. Not all collections need to be paid, right? So that's why you want to speak with us first, and we look at it, and we'll let you know what needs to be paid. Versus you going to pay things blindly, and then you decrease your credit score, right? So have that conversation. Go ahead, Ash.
No, I was just going to say that there's people like, oh, they're hesitant to speak to this is like actual conversation DMs. They're hesitant to speak to a lender, but they're like, oh, I'm working on my credit. And I say like politely, but it's like, okay, but if you haven't spoke to a professional, how do you know what to work on? And they'll be paying all this stuff off. And it's like, if they paid everything off, okay, great. But then you have no assets for down payment. Or they paid it off and it was like, you need to pay that. That was about to fall off. Or like you just reopened it. So yes, totally agree. Speak to a professional first before you start doing those things so they can guide you. Helena asks, is it best to add the rent to the credit score? Let's say if you're paying it consistently, you're a good renter.
That's exactly what I just typed right before you said that.
Oh, okay.
That's hilarious. If you pay it on time, you should add it to your credit score. If you don't pay it on time, don't add it to your credit report.
What was I going to say? Oh, I was going to ask.
Wait, okay. Sorry. So I want to elaborate. So, okay, I understand with the whole, like, if you're going to pay it on time. I guess I'm just concerned because, I've learned a lot about credit cards, like, in the most recent years as an adult. And I understand now how things work. Like you said, if you have $1,000 credit card, then you don't want to spend $1,000. And you also don't want to keep $1,000 on your card the whole, like, every month.
Right.
But it's like if you have rent and it's a couple $1,000s, then you just need like a higher credit card so that you're paying the minimum of that. You know what I mean?
No, so yes, I do know exactly what you mean. And let me offer some clarity for you. So credit cards are revolving trade lines. The rent's not revolving. Your card note's not revolving. Right? All those things those are different types of trade lines, which means if you could pay it, you can use it, you can pay it, you can use it, you can pay it. With the rent, it's going to be like an installment, right? So it's going to be just this amount every month. So long as that amount is paid every month, it's not a balance thing like your credit card would be, right? So it's mainly tracking your payment history versus the balance of what's owed. Right. So no late payments. Right. So And late payments, let's have a quick second on late payments. Do we know the definition of a late payment? Not late like you had to pay a late fee, because let's say your rent's due no later than the 5th, right? So you pay it on the 7th, you have a late fee. That's not a late, because it's not going to report to your credit. A late is when something is 30 days late, right? That's when it's reported to your credit. That's what we consider a late, right? So if you pay your rent every month on, on the 28th, you might have rack up a bunch of late fees that you might have to pay your owner. But it wouldn't necessarily show late on your credit report per se, right? So that is the definition of late. I hope that adds a little bit of clarity for you, Helena. It's not the same as a credit card in terms of how it's viewed, because it's not revolving. So there's no balance that's going to fluctuate up and down. It's going to be one set payment that you make every month, just like your car payment would be, and it would decrease. Perfect. She says yes. Thank you. Okay, we can. Any other questions on credit? Oh, go ahead.
I just want to throw it in because a lot of people, when I say, oh, you should connect with the lender so they can look at your scenario and guide you, they're like, oh, well, I don't want to get my credit pulled. When someone gets their credit pulled, I'm asking you, Otis, like, how much does it affect their credit score? Because there's like a lot of hesitancy with getting that credit pull. Just really see where they're at.
Yeah. Two parts. I got to answer that question in two parts. First, answering your question in terms of the credit score impact, any hard inquiry impacted. So if you go buy an iPhone, right, they're gonna rate your credit, and it's gonna have a hard inquiry. But you want to buy a house, so you don't want to run your credit. Anyhow, so usually normally a 3 to 5 point per hard inquiry.
Okay.
And that's at max, and that's per hard inquiry. So let's say if you're shopping for it, so if you run your credit with your credit union and with me, and you're shopping for a mortgage application, that's not 2 inquiries. They will show 2 times, but there's only going to be a 1 point hit because you're shopping for it. As long as you do that within a 21-day time period, it's only going to have 1 point decreasing hit, right? All the inquiries will show, but you're allowed to shop for something. Now, you can't do it this month and then run it next month, because that's going to be 2 different inquiries and you're going to get 2 different point hits because you're outside of the 21 days of shopping for something, right? So that's important to note as well. And also too, when we run your credit for a mortgage application, that credit report is good for 120 days. So it's not like we got to run your credit report every month, right? So which you may need time, more than likely you're going to need time. You're not going to run your credit and go get in the house tomorrow, right? So it's more than likely going to take you some time to find the property, a couple of months, and you really need the credit report because you need your pre-approval validated, right? In today's market, and Ashley will tell you this, and Ashley's probably not going to show you any houses if you don't have, an actual pre-approval, because a lot of sellers don't want you coming to the house if they don't know you've done a due diligence to even possibly afford this house. They don't want random people walking through their house. And Ashley doesn't want to be wasting her time and showing houses and, that may be above your price range, et cetera. So you want to know these things up front. It's not running your credit. It's not to hurt you. It's to help you and know exactly where your guidance is. There may be something on your credit we could clean up and make this whole situation better. Maybe we can get you a 20, 30 point increase and get you a better interest rate. So you want to do that if you're serious. Maybe you're not serious about actually going into buy right now, and I just kind of want to preliminary see what I look like. We can have that conversation too. I'm not opposed to that. We could talk about that. I say, hey, send me your most recent credit report that you have. Send me your income. I could give you an idea of what you may be looking at, but that's not a pre-approval. Ashley can't go show you houses and you write an offer with that. But you could at least have a good standpoint of like, okay, this is what I look like on payment. This is what I look like. Maybe you want to start there. Maybe you take baby steps. I'm with you all the way, no matter where you are in the process. So I hope that answers the question.
Yes, like pre-qualification. And the reason, as an agent, that I wouldn't take someone out to go look at properties if they're not pre-approved is not because like, oh, I want to waste time, not like that. It's just because how do we know how to focus our energy if you can truly qualify for it without doing those steps first. Plus, in order to submit an offer, you have to have, it's like literally one of the requirements for submitting the offer with the purchase agreement is the pre-approval letter and proof of funds saying like showing your assets. So like it's required. So that's a part of that. But yeah, I think Otis answered all those questions. I don't see any others.
Yeah, we'll go to the next one. As we're talking about credit, we're going to talk about, because that's the kind of the first kind of piece you need, and then we'll talk about what you need to get pre-approved, like in terms of documentation for the next little section. So what you need to get pre-approved, this particular section is going to be for those who have jobs. Okay, for those who get a W-2, get a paycheck stub, you get paid hourly, salary, bi-weekly, weekly, etc. These are the documentations that you would need. So we look for your last two recent pay stubs, your last two most recent bank statements, or any account that you're planning to use. So maybe you have a 401k account or a money market account where you've been saving your money that you want to use for this transaction. We need two statements from that. And then we need the two most years W-2. So right now, like we're collecting 23 and 24 W-2s. In a couple months, we'll be collecting 24, 25 W-2s with your application. Copy of your ID, Social Security card, and then a completed application. And the applications, at least done with me, unless we do it in person, it's typically completed online through a secure portal that I have. So you get an email. It's going to have a link to there. You're going to create your account and fill in your information. It then gives it back to me, and then that's your completed size. So these are the documentations for those who have a job. But there's people who also buy houses that don't have jobs, right? They might be a business owner. They might be a self-employed person, 1099er, gig economy. I've had it all. I've had every type of client that you could expect. I've had OnlyFans clients purchase property with their OnlyFans income, right? So anything and everything under the sun, there's ways to do that. Can we go to the next screen? We're going to talk about what the self-employed and business owners need for their qualifications, right? So if you're self-employed, we'll look for your last 2 years of your tax returns, your business and personal tax returns. Also, too, or we'll also look at your year to date. So depending on what time of the year you're purchasing. So let's say right now it's the end of the year, and you like I have a couple stylists, right? Beauty stylists that I've helped. So we'll look at the 2 years previous tax returns, and we may look at a year to date to see what they've done from the beginning of this year to November to make sure that the income is averaging, what they said they make, because we're trying to show we have to prove the ability to repay this loan, right? In these instances. And then we'll talk a little bit about other loans that you don't have to do that on. And then if typically a 1099, so Uber drivers, Lyft drivers, any of those types of things, these are the type of documents that we would need for that. Okay. Any questions so far on the W-2 documents, or if you're employed, or if you're self-employed, or if you're a business owner, the documents that you would need?
In the chat, someone asked, what about purchasing a property under your business?
It's a good idea if you have an established business. It can't be really a new business if you want to purchase a property. Now, what you can do, what I've had a lot of my clients have done, they've purchased a property with themselves, and they deeded the property to the LLC or to the company, to the business, limiting their liability, but they need to qualify. So your business would have to qualify to do that. And typically you're going to put down a much, much larger down payment if you want to buy a property in the name of a business. We're not talking 3.5% or anything like that. You're talking 25 to 30% at a minimum if you want to buy it in the name of your business in most cases. But it depends on what you want to purchase the property for. If it's a business purchase property, if you're going to like maybe a daycare or something like that, and you want to purchase it in the name of the business, completely limiting yourself, you could do that, but it will cost a little bit more to do it that way.
Okay. Before we move along, I don't know if you covered this, sorry. What if someone has both? Like, let's say they are self-employed, maybe it's like a slower season of the year, so they're like, okay, I'm gonna do some, the gig thing on the side. You can combine the two.
Good question. Yes, you can combine the two, but whenever you're going to use two incomes or multiple incomes for a borrower, they must have 2 years of earning two incomes. So you can't like be like, okay, I'm gonna go get another job right now and
Mm-hmm.
then add that into it. It won't work
Oh,
that
okay.
way. So it has to be 2 years consecutively uninterrupted of you earning two incomes. Now, that doesn't mean you were at the same place. You could be in different places, but you had to have two incomes coming in consecutively for two
Gotcha.
years to use it.
So what if someone, let's say for example, they're self-employed, they're doing the gig thing they just started 6 months ago. So you can't count that income, but the money they were stacking and saving, you could like not count that income towards them qualifying, but they can still use the assets.
Correct. Yeah, anything that they have saved up, as long as it's in their bank account, and we can track it that way, then that's no problem. But we
Gotcha.
couldn't use it to qualify them if they don't have the 2 years of it. But that's a great question.
Gotcha.
Um, on that, and another part I want to add about this to this business owner thing before we move forward is is bank statement loans. Has anyone ever heard of a bank statement loan as a mortgage? Getting a mortgage with the bank statements, with your bank statements, if you own a business, okay, or if you're self-employed. So there are bank statement loans that are available as well, which I do a decent amount of those, but it's for a particular client, right? Someone that I don't have my tax returns because I wrote off all of it, right? Because I didn't want to pay Uncle Sam. So I can't show my income through tax returns, but I can show my income through my deposits, every month. So there are 12-month bank statement programs. So we can look at 12 months of your bank statements and use a portion of that as your qualifying income. Um, so and you can do this too, like same with you. So let's like you just asked Ashley, someone has a job and they have the 2 years of doing this. We
Mm-hmm.
can use that bank statement 2 years and their W-2, right? But we just have to have both years of it. So I'm glad I told y'all something nobody's ever heard of. Good. So you guys definitely learned at least one thing today. In terms of the bank statement loans, those are what they call non-QM loans, non-qualified mortgages. So we're talking mostly you're going to hear information about qualified mortgages, your FHA, conventional, BA, where most loans are originated. But today, because a lot more people are earning money outside of just the traditional job, there are more loan products that are starting to come out that, to help you do that. So bank statement loans are one, and it kind of pertain to this. So I wanted to make sure I said that before we move forward, Ashley.
Okay, dog. The other questions you've already answered. Oh wait, hold on, hit the wrong button. Oh, quick question before we start the loan process.
Yeah.
I don't know where it would like best tie in, but gift funds, just kind of wanted to throw that out there. Sometimes people are very fortunate where the grandparents or their parents or whoever the case may be, you're purchasing and you can do it on your own, but they're like, we're willing to gift you a certain amount. Can you briefly explain how that works? And like, they have to like, they can't just like give you the money. Like there's a process to it is what I'm trying to say. Because I've had
Right.
before when like they were about to like Zelle. I'm like, no, wait, time out. That's not how you So can you briefly explain how that works? So it's done properly if someone has that blessing.
Right. So today, I would say most loan products allow for gifts. There's some that don't, but they're most like investor type loans. But most loans will allow for gift funds. Gift funds meaning if someone's going to give you some money towards this transaction. Your mom, your brother, your cousin, your sister, your uncle. They used to care about who it was. I don't think they care about who exactly who it comes from any much anymore. They do want it to be in relation, but we all cousins, right? So with the way that gift funds work, but it does need to be sourced and tracked, right? So it means like Granny can't go and get her pocketbook and pull out 20 grand and give it to you, and we use it for this transaction, right? So any money that we use, it has to be tracked. So if someone's going to give you funds, we have to do what's called a gift letter. And a gift letter is simple. We're going to fill it out for them, and they're going to sign it and say, I'm going to gift Miss Monique Collins, my niece, $10,000, right, for a purchase of a house. They're going to give us that letter, and they're going to give us one bank statement showing that they have that money to give you, right? It can't just be like, yeah, I'm giving it to you, but we don't know where it's coming from. So the letter, one statement, and then we can utilize that as gift funds. So typically the way that works, they can now at that point, once we have the gift letter and the bank statement, they can give you the funds. We don't recommend that because then we have to get another statement from you showing it come into your account, come out of your account. It's a mess. The easier way is to have them Once we get to closing, go ahead and wire that same amount or whatever amount that they're giving you directly to escrow. You wire whatever amount that you have to escrow, and then they close it out. So that's a great question, Ash. I'm glad you brought that up. Gift funds, um, in terms of how that works.
Okay, cool.
Okay. So we'll jump into the loan process. It's not as fun as going out with Ashley on the home buying process. Like you get to
Now the
see the
fun one.
houses. Yeah, it's like, oh, the cabinets are so cute. Um, Not as fun with me, but you definitely will learn a lot. And this is the big part because this is how you get to the actual goal of getting the keys to the house and starting, to build a generational wealth for your family. So we started loan pre-approval. We just talked about the documentation that we need, the credit and, the W-2s, et cetera. So we start with the loan pre-approval. So I get all that stuff in, I analyze it, we go over it. You have an actual loan pre-approval. And then you and Ashley, you guys go out, you guys find a property, you like it, you submit an offer. It may be a few offers before you get one accepted, um, especially in today's markets. But let's say, hey, you found one, you like it, offer accepted. Woo! But that's when it gets real from the loan side. It's all fun and games when it's cute where you guys are going out every Saturday looking at the houses. But like when the offer's accepted, the clock really begins, right? Because typically in our market, 30 days or less is most of our transactions, right? Unless it's some other circumstances where it's a longer contract or the seller needs more time or whatever. In the next 30 days from them accepting your offer, this is going to be your house. And you're going to owe somebody hundreds of thousands of dollars, right? So most people start to freak out at that point, right? Ashley, oh my God, this is a bad idea, right? And that's completely normal to feel because it is a big step. It's in most people's is going to be the biggest step that you've taken in your life so far, right? So we understand that, but we get the emotion part together because you started for a reason. That's why we ask, what's your reason why you want to do this? So if it's for your kids, if it's for your family, you know that it's bigger than you, and we got to sit through it. So we get into our deciding of disclosures. That's when you'll get your initial loan estimate in terms of like what everything's going to cost you, the title and escrow fees, all that stuff. You get all that information. If you've been looking for a little while, we'll update your documents. Maybe it's a new year, so you got to update your W-2s or pay stub, et cetera. And then we submit that all to the underwriter. The underwriter is going to review it. They're going to give us we call in the industry a CLA, right? A conditional loan approval. That means we are like almost there. That means this loan is going to be approved as long as you give us these conditions, right? So example of conditions may be a copy of the appraisal, right? Because that may not have come in before we give them the actual file. Because that happens in the process once your offer is accepted. We want an updated pay stub or some very interesting ones. Maybe it's you were divorced and we need a divorce decree because we didn't have that on file, right? You want to make sure that nobody else can come back later and say they own this property, especially in California because it's a community property state. So these are just some examples of what conditions look like. We fulfill those conditions and we submit it back. And for the three favorite letters that Ashley loves to hear from me is CTC, clear to close. Okay. That's when everybody can woosah. I'm not getting on your nerves as much anymore because we are clear to close and everything has been finalized by the underwriter. Your docs will be sent over to escrow and then you get to sign loan docs, right? So it's like, what they say, signing your life away, right? That's when that part happens. And we'll go through and that's going to have all your final stuff. You're going to have your note in there, your deed, all of that stuff. Typically the next day, the escrow office will record that with the county in which you're purchasing in. So LA County, Riverside County, Orange County, wherever. And that's when the title changes from the seller to your name. To Miss Monique Collins is the new owner of 123 Avenue. That's when Yurusa Ashley brings the keys and the gift, and it's absolutely all over. That typically is going to happen again in 30 days. That's a lot emotionally to happen in 30 days. So we completely understand that and don't feel like, oh, I don't want to be like that. It's normal to feel that when you're borrowing hundreds of thousands of dollars in an uncertain world that we live in. But that's why you have a team, right? That's, to make sure that you're educated throughout the process, and you never feel alone. And our clients are our clients for life, right? Every client that me and Ashley help, we still talk to today, right? If they need any help, anything from us, they still reach out to us, and we're still able to be an asset to them. So, any questions on the loan process or anything you want to add to that, Ashley?
I was just going to add in, like if you see, like when you hear from people or, I don't know, media and stuff, like when people are like, okay, the process is overwhelming, but that's also why I mentioned earlier that very big on educating the clients. Like I literally during consultation, we go through a sample purchase agreement. So, because it's a lot, like, and I want you to see it ahead. Of course, you're going to forget parts of it, and you'll have questions again later, and I'll just answer those questions again later. But it's kind of the preparation behind it because it is a lot for escrow. All this happens within 30 days, but that's why we prepare you. And then I was going to mention how you set the disclosures and all that. Your numbers, the numbers are never a surprise, or at least they shouldn't be. Otis is going to tell you ahead of time, like when you do the pre-approval, what these look like. Once you actually identify the property, what those numbers look like, and then of course again before signing your loan docs. But I've heard like some people who are like, oh, I didn't know, or this and that. And it's like, how did you not know? Like, or who did you work with? Because
I didn't want to know.
Yeah, it's like it's clearly explained. So the element of surprise, like I said here, but of course, it's a big process that happens within 30 days. Like you said, we have your team, and we step you through it, answer all the questions. I think it's funny because during escrow, like I don't know, clients communication like daily or several times a week, and then they close and are like, "Yay, congrats!" And it's like, "Hey guys, I miss you. Where you at?"
It's like break it up, yeah.
So used to saying communication, but it's a good thing though because that means we accomplished your goal. But yeah, that's always funny. I haven't talked to them. It's been a week. So yeah, that's kind of how that process goes. I know it's a lot of info. Any questions? And of course, when time comes, we all like break it all down. No
Okay,
questions?
we can go to the next one. All right, I'm almost done, guys, but I want to cover a couple more things. So I have this thing called know your numbers. In the loan officer world, we always talk about knowing your numbers. And so this is for you guys in terms of potential home buyers, like knowing your numbers. So maybe some questions that you have asked yourself, or maybe you should ask yourself, right? And this makes you just more comfortable to having the conversation with Ashley or myself or any, real estate or mortgage professional. Because like you never want to feel like somebody's like intruding on your stuff. You know what I mean? And or they're being invasive, right? So, but you don't feel that way if you kind of have done the work already, right? It doesn't feel invasive. You're aware of it. So, what's your current income? Now, if you're salary or you get hourly work, you probably know what your income is, right? But if you have a side business or you have a business, you may not know exactly how much money I'm making. I just know I can pay my rent and my bills and things like that. But where's my actual income, right? And then what are my current credit debt obligations? Because that's what we look at from the mortgage side in terms of when we approve you, your credit debts. So we don't look at your health insurance premium every month. We don't look at your car insurance premium every month. We don't look at your daycare every month. We don't look at any of the other costs things that actually cost you. So what are your credit debt obligations? Because those are going to affect your affordability in terms of actually purchasing the property, right? So let me give you an example. Let's say you have a credit card and the payment, it's a little high right now because you went on a Carnival cruise this summer, had a little good time, so the balance is a little high. And let's say the payment is $400 a month on the card, right? Whatever, you can pay it. It's not a big deal, right? And so you can pay the $400 a month, but you're like, I want to buy this house. So we do the application and like, oh, okay, $400 a month on this credit card. And I would say, hey, well, if you paid this down to where the payment was $200 a month, it would actually give you an extra $10,000 in buying power. You'd be like, what? Right? So $200 could have that large impact because you got to remember it's over 30 years. We look at $200 as dinner per se one night, but $200 in terms of qualifying, in terms of how much you're paying on something every month, has a huge impact on how much you qualify for. So like we see all the time, you're like, oh, well, this person got this house, or whatever. Somebody has $1,000 car note and somebody had a $400 car note. There's a difference in terms of how that worked in qualifying, right? So just knowing your numbers. What are my credit debt obligations? And then how much can I afford in a monthly mortgage payment? Now, obviously, we want to all spend the least amount as possible, right? But we have to be realistic, especially we live in California, right? Other than New York and Hawaii, the most expensive, real estate market in the United States of America. So what can I afford, right? What can I stop spending money on that I can afford and maybe put more money into the house, right? Kind of do that little bit of homework. It gets a little uncomfortable because I got uncomfortable when I seen how much I went to Starbucks. So I was like, okay, I gotta chill, got me a Keurig, like let me get it together, right? So, just do that little assessment to kind of see where you are and making sure that, you're in a good place. Next part is what do I have saved up for my down payment and closing costs? Some people forget that when you buy a home, Ashley, tell me, we both heard it. Oh, there's closing costs? Well, I've got my down payment and I didn't know about that other part of it, right? So do an analysis of what do I have saved up or what's my plan or where am I at or how am I getting there, right? Um, that's super important to know because maybe you might be like, I'm going to use the 401k from that job I had 7 years ago. That's been sitting there. We'll use some of that money. I have this savings, whatever, figure out where you are. These are things you should do on your own so that you're more equipped to when we have the conversation, to answer the questions. And then, like I just got into, what are you currently willing to sacrifice to be able to purchase this home? Right. And that's a tough question to ask. Right. It was tough for me. Now I'm drinking black tea in out the Keurig, right? So what am I willing to, partake? Because realistically, you may have to make some sacrifices, but for sure it's going to be worth it. Because if so, why everybody would buy a home if everybody could buy a home? Everybody would. Why? Who wouldn't want to? Right? There's value in it. That's why there's a barrier to get into it. If there was no value here, then everybody would get into it. Everybody could do it, right? There's value in it, so you know that it's important. So what can I sacrifice? So maybe it's like, okay, I don't get the Beamer, I might get the Kia, so I could get the house I want. You know what I mean? Or so that I get a property, and then once I get a property and I can build some equity, now you can really play a different game. You can get whatever car it is that you want. But in the words of the great Earl Stevens, better known as E40, don't buy $85,000 car before you buy a house, right? So just be very knowledgeable and diligent in terms of what you're doing with your money and knowing your own numbers and know your top five. Any questions about that? Helena, I'm sorry I had to call. I had to tell them about the Carnival Cruise. It's the truth.
What's it called? You mentioned closing costs, like about how much your closing costs.
Great question. I'm glad you asked. So closing costs first, before we talk about how much it is, let's talk about what it is. What is that? It just seems like it's extra money you're charging me, as my mom would say back in the day. So closing costs typically has three components of closing costs. There's your third party fees, which are what the title and escrow company charges for their services, right? So title is used to make sure that the title of the property is clear, that what you're buying it from the person, they have the authority to sell it, and you're going to be the new owner and nobody else can say they own it. That's what title does. Escrow is a neutral third party that holds all the contracts and all the money during the transaction. They have fees. So that's part of your closing costs, right? The other part of your closing costs is called your impounds, right? Has anyone ever heard of impounds when it pertains to mortgages? Oh, I'm cooking today. Actually, they're learning a lot. Okay. Mm-hmm. So impounds are your property taxes and your homeowner's insurance, right? And most loans, that's going to be included in your monthly payment. So when you close, they're going to pay your first year of homeowner's insurance upfront. That's a part of your closing costs. Depending on the month that you close, they're going to pay a portion of your property taxes because property taxes are due twice a year, April 1st and November 1st. So they'll take that as a part of the closing costs so that they can pay that on your behalf. So you're not ever worrying about paying your property taxes. It's already wrapped into your monthly payment. That's the other part of closing costs. The third component of closing costs is the lender costs. So if there's any lender fees, if you're buying down your interest rate, anything like that, that's what your closing cost is. So closing costs can vary. So it's hard to say what the exact amount is. But I would say that the average rule of thumb, it's between 2 and 3% of whatever it is that you're purchasing. So let's say, for instance, if you're buying a property for $500,000, closing costs may be an extra about $10,000 to $12,000. And that's not including now if you bought down your rate, it may be a little bit more, right? So it's going to be very particular to each individual situation, but those are the components of closing costs. I know y'all didn't know it was involved in closing costs, so y'all you got something there as well. But that's what's included in it. And like, what is escrow? Did you hear everyone? Okay, so Kara, so escrow is the neutral third party in the transaction. So
No, I think she was saying the closing costs, how you were saying how it's, well, the way I read her question was how you're, all those components, like, how the escrow account basically for your mortgage.
Yeah, so impound and escrow is the same word.
Yeah.
Right. So some might refer to it as an escrow account. Some might refer to it, lenders, we refer to it as an impound account. Clients in the escrow world will refer to it as an escrow account. It's the same thing.
Okay.
It's essentially it's essentially a savings account for your homeowner's insurance and property taxes.
Okay.
Okay, cool. Any other questions? We'll move on.
Okay, so we'll move on to the next page, and then we'll wrap up and do some last Q&A. So this is a little bit of a market update. I'll read some of this. I won't read all of it. I'll just give you guys the information that I have. So California's real estate and mortgage market. Obviously, there's a lot going on right now, right? A lot. And not only just California, in the entire country, in terms of financials and things moving, et cetera. We don't even got to get into it, right? We know that it's a lot. So we don't expect 2026 to not come out and show its tail as well. So we looked at some of the forecast information for 2026. I've seen some ups and downs. Overall, we're still looking at, in California, we're going to see home prices increase next year. Although interest rates have started to come down, they're still a little bit high, and home prices are still going to increase. So everyone's been waiting for the crash. It's not coming in 2026, okay? Unfortunately, right? Home prices will continue to happen because we have, in California, especially in Southern California, a supply and demand issue that we can't build fast enough to fix, right? There are more people that want to be here than places for them to be. Then you add in, there's more people that want to be here that can afford to be here, like in a place they want to be. That creates a supply and demand issue. So there's always going to be people wanting to be here, which is going to keep the prices going up, right? Until people say, I don't want to live in LA no more. As many people as left, it's not enough to get us to where we're starting to see our prices decrease. We've seen them stagnate a little bit. We're seeing properties stay on the market a little bit longer, but they're not falling, right? So for an example, like there'll never be a house in Ladera for $500,000 again, ever. No matter what happens to the market, right? There was a time when I first started in real estate, there were houses for $300,000 in Ladera Heights, right? When I first got my license. That'll never happen again because of simply supplying. There's no more Ladera Hills. There is no more of it. So if you want to be there, you got to pay to be there. That's not going to stop happening, right? In 2026. In terms of mortgage rates, let's talk my side of it, right? Mortgage rates have began to decrease, right? Very, 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 very slowly. Very, 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 very slowly. Not as I mean, I wish they went up this slow. They went up a lot faster in terms of this, but they're going down slow. So the Federal Reserve has begun to cut the federal funds rate. Now, that doesn't mean they cut interest rates on mortgages, right? There's a huge misconception of that, or interest rates on credit cards, any of that. So the Federal Reserve lends money to banks at an interest rate. They cut that rate. It's up to the lenders and the banks to then pass on or cut whatever they give to us as consumers, right? So they have what they call as market expectations, right? The market expects good or bad or the same, et cetera, right? So if the market is expecting them to cut rates, the lenders will see that. They'll make the rates a little bit lower, a little bit cheaper, and then then the Federal Reserve will actually cut the rate. And you're like, well, the interest rates are getting lower because they've already priced that in, right? So we just seen 3 days ago, the Federal Reserve cut the interest rate, right, by 25 basis points. It did absolutely nothing for mortgage rates yet, right? Because that already happened for us 3 weeks ago because the market expected that, right? So the next meeting is going to be in December, the Federal Reserve. Well, they'll make a decision whether they'll cut interest rates again or stay. I would say they're more than likely going to cut interest rates again, by another small incremental 25 basis points, and won't see any major change in interest rates for us in terms of consumers yet. I do think we'll see consumer interest rate changes into the first quarter, maybe March, April. We'll start to see like, oh wow, there's a 5 point something, like, and it doesn't cost X amount of dollars to get it. I think that's coming hopefully sooner than later. The problem is that's going to drive inflation back up. Inflation in housing. We're talking just about housing. So all these houses today were, especially in LA, let's just use LA specifically, were 20, 30%, 40% less than they are 4 years ago. Most houses between Century and the 10 freeway, most of those houses were 40% less than they are 4 years ago. Those are inflated prices because when the rates were low, people drove up the value, right? Now, it's not, although the rates got super high and crazy, and I was scared. I thought I was going to have to get back my Uber account and get back out there. Even when the rates were high, we still didn't see home prices fall like drastically. So as the rates get cheaper, the values are going to click back up because it's going to get more competitive again. So more people are going to get back in. So I would venture to say that if buying a home is like something you want to do, if it's like whatever to you, then it's whatever. But if it's something like, okay, this is a real thing for me, I would try to position myself. If you got to start with the credit, whatever it is, but just make sure the ball is rolling as soon as possible, because the next time this inflates, it's going to be, if we think it's unaffordable now, it's going to be worse, right? Where there won't be any houses under $1 million in LA. And we're not far from that now, right? So I don't want to like be doom and gloom, but I want you to be prepared and, have the expertise and the information, and know the severity of it. Again, only if this is something that means something to you, right? And I would assume that it does if you're here this morning on Saturday. You could be anywhere. So it's a little bit of a snapshot. Obviously, things could change with the administration that we have. A lot of things could change at any given time, but that's kind of what we're seeing right now for the end of 2025 and 2026, the beginning of the year. I think real estate transactions will pick up next year. I think more people will transact. It was a little bit light the last year and a half, but I think that will happen more. But at the same time, home prices are still going to continue to rise. So unfortunately, homes are not going to get cheaper, at least in LA, next year. LA County, like Palmdale, Lancaster, which is technically still LA County, those home prices are still rising. Right now, they have the most active transactions because that's where people move to and from the most right now, since they stopped doing that with the Inland Empire. So, even what we would call the outskirts of LA County are still seeing home prices increase. Right. So just something to be aware of for 2026. Anything you want to add or any questions, Ashley?
I was going to say, so from your recap, also I want to throw out there, when you guys look at the news and all that, pay attention, because a lot of times they're saying national and they're not referring to our market, and our market is usually going to be pretty different than elsewhere. Like when things slow other places, it's LA, like people are still coming. But I wanted to throw out there, so you did kind of recap all this, right? So are you saying, like, it sounds like you're saying, if someone's, this is the goal, you're still serious about it, kind of basically put a plan in place and still move forward. Don't try to wait out the market and see what the rates do or if they drop
Yeah,
off.
it's impossible to time.
So just
Yeah,
compare.
the right time is your time, right? So like when you are in a position where there's a payment that you could afford and there's a house that you like, that's when it's your time. There is no forget what the rates are because rates change up and down all the time, right? What the payment is what you make every month. You don't make the rate every month, you make the payment every month. So I would venture to say make sure that you focus on what is my affordability? What can I afford every month? Then can I find something that fits what I can afford? Right? If you can't find something that fits what you afford, then that's your homework. Maybe you got to lower some debt. Maybe you got to get a better job. Maybe whatever, but at least you have a true starting point of exactly where that is when you say what's that? Because that's the otherwise you'll fixate yourself in which a lot of people do, and then they make themselves wait and they do nothing. Oh, wait till the interest rate. They said it was going to go down in March or January or whatever. Like it might or it might not. The fact of the matter is, every year that you go by not owning the house, it costs you more to own the house. The same house. That's the only fact. I handle emotions, but we try not to deal with them in the financial world because it'll take you away from what you want to get to, and then we just deal with the facts. So the fact of the matter is, rates will get cheaper, which means the payments will get cheaper, but the house price is not going to get cheaper, right? But you're also going to be competing with more people as rates come down, right? Because now you may say there may be someone that say I'm gonna help my daughter buy a house right now, but the rates are too high. So the rates come down, and now you got to compete with him, who's going to give his daughter a gift. You get what I'm saying? That everybody comes out the woodworks when the money gets cheaper to lend, to borrow.
Lower rates means more buyers, which means more competitiveness, which means they drive the home prices up. So during the pandemic, it was crazy. They got literally 15 offers. One client, we had to submit 10 offers before their offer.
I got you beat. I got 19.
And
I had a
was
client
crazy.
send 19 offers
It
before
was
they got one
crazy,
accepted.
but we did it. They got their place, and now they're happy. They have their equity and all that. But now it might be where, like, I don't know, they have a few offers, maybe 3, 5. So the rates are higher, but it's less competitive. So your odds are much better. The odds are in the favor of the buyers now compared to when the rates are lower. So it's kind of that give and take. So basically, he's saying, don't try and time the market.
Right, and you can always lower the payment. We're close. We just signed a deal yesterday for some clients up in Stockton. I helped them buy the property in 2023. Rates were, I think that was the highest. That was the highest rate that I ever did on a regular loan ever in my career. I was like, ow, right? It hurt. They were buying it because they do adult convalescent homes there. So they bought the investment property there 2023. We just lowered their rate by 2.5 points this week, right? So now they're going to save about $450 a month in the payment. But if they didn't get the house in 2023, then they wouldn't be saving the money now with the house that also has appreciated since then. So again, that's why I said don't fixate yourself with the rate, fixate yourself with the payment. What payment because the payment's only going to go down from there. It's not going to go up from there. And that's a mindset thing that we have to get out of because if we've been renters, we're used to like the longer I stay there, the more it's going to cost me to stay there.
Okay.
We're purchasing a home, the longer I stay there, the less my housing payment is going to be. Because I'm going to be paying down the interest, I'm going to be paying down the principal. All those things are going downward, right? But that's a mindset thing, right? So again, fixate yourself on what can I maximally afford on this payment now because I'm only going to go down. Rates go down. So right now, he's eligible. They're going to be eligible for another refinance in 6 months. So if I can save him another couple $100 in 6 months, then we'll refinance him again in 6 months and save him more money. But again, if he never got the house, he couldn't save the money later.
Any other questions?
And I hope you guys got my humor. I can be a little out there, but I like to be real and transparent and authentic about what we do, make it fun, but nonetheless, it's because it's very serious. I do take this business very serious. But we got to have some fun with it. Otherwise, what we here for? So this is our contact information. We can be reached on your socials, websites, direct phone numbers. If you'd like to speak to us afterwards and schedule a call or meeting.
Yeah, if you're not already following me, please follow me. I'm most active on Instagram. I forgot to pick TikTok on here, but I've joined TikTok. It's more fun than Instagram. But yes, please follow me on social media. And then also be on the lookout for an email. The email will contain my buyer's guide for you guys to kind of breeze through, get some information. I will also include, it's a link to my YouTube channel. I have like these, they're short buyer videos, and it kind of steps you through the process. I explain everything like within like a 2-minute video. That's just kind of a way. I know a lot of you aren't like the immediate buyers. Like I need to be in the house with the next 90 days, more further out. So it's a good way to kind of get the information. Okay, cool. I'll call her in a second. And then I will send you guys in that email as well links to both our calendars, because we'd love to have one-on-one calls with you. Nothing crazy, maybe 15 minutes, kind of see where you're at in the process and how we can help you prepare. Even if you're out, it's always great to start preparing ahead of time. A lot of people wait until they're mentally ready, and then sometimes, okay, you're mentally ready, but maybe you're not financially ready. So we want to prepare ahead of time. So when you're ready to go, you get to go. We're not like, there's no hurdles with credit or anything like that. Let me see what else. If you guys have any friends or family that we can assist, please feel free to share the information. Like I said, help people. They tend to workshop in all different states. So please keep us in mind for any referrals for family or friends. And then go ahead. I see your hand raised.
Okay, I have a quick question. I listened to the information about a lot of people still coming to LA, and they are, and housing prices going up. But I also think like some of the houses I've been looking at, like they're averaging now 100 years old.
Mm-hmm.
And so a lot of the homes it looks like they have foundation issues, like they have some issues. It's going to take quite a bit of money. How are people dealing with that when they buy these homes in LA? And like, is it some type of extra lending or grant or something like that that people are getting access to, or maybe just their own money saved to pay for some of these upgrades, like electrical in some of the units?
Great question, Ms. Kira. Um, there's not one answer to that because there's a lot of different ways. But from our side, like we have construction loans now, so which we do. So like let's say if you buy a property, or we have renovation loans as well. So we have construction and renovation loans. So if you buy a property that needs like a facelift in terms of maybe some work, maybe some foundational work, etc. There are loan types for that where you could purchase a property and the work that you're going to be getting done is financed as well through the mortgage. So you do, there are some of those options out there. So that's a lot we see because you're like, where does everybody get all this money from?
Right. Is it like a second mortgage? Like they'll get like
Yeah,
a second mortgage?
so not necessarily you can do it in the form of a second or a first. So there are loan products that I have. Like for instance, we can give you an example. There's an FHA 203K loan, which is a renovation loan. Have you ever heard of that?
Mm-mm.
Okay, so FHA has a renovation loan called a 203K, and the 203K has two different ways you can use it. They have a standard and they have a full. A standard means that the renovations you want to do to the property are going to cost less than $35,000. Right? And that's called a FHA 203K. So essentially, you're gonna finance that into your purchase. So let's say you're buying the house for 500,000, and you're gonna put $20,000 worth of work into it. So you're gonna do a loan for 520, and your payment's gonna be based off of 520. Right? So that's the one way to do it in terms of the renovation loan. Then there's the construction loan. Let's say, and like I had one person I was hoping with, but they had some stuff going on from the fires in Altadena, right? Where they bought actual like land and then they were going to like rebuild the whole house. So we have loans that can help you purchase the land and pay for the construction. And then your mortgage payment is based on those two loan amounts.
Now, is that like some of these some of these products, are they going over the loan value of the house, or that's like me coming up with a bigger down payment for them to do
Yeah,
that?
they have. Yeah, so what's required then is what's called a ARV appraisal, which is
Uh-huh.
a after renovation appraisal.
Okay.
So they're gonna because they don't want you to go put 50 grand into it and it only makes your value go up $10,000, right?
Right. Right.
Because renovation is not dollar for dollar in most cases,
Mm-hmm.
right? Just because it meant a lot to you for the red door that costs 3 grand doesn't
Mm-hmm.
mean that it's going to make your house worth $3,000 more, right?
Right. Right.
So if it's when you're doing like a construction loan, or if you're doing like the 203K and it's going to be more than the 35,000, they require you to hire a certified HUD counselor, instructor, to essentially act as your project manager. So they're making sure that this new this renovations or the construction you're putting into the property is going to value at this new value.
Okay.
You get what I'm saying? So all of that's done
Right.
within the process. So but it's not, you don't have to figure out guessing after you close. By the time you close, all of that's already figured out. So it's not, you
Okay.
don't close and then figure all of that stuff out. In the time you're doing the construction loan or the renovation loan, all of these things are happening in the time period of it.
Okay.
Right.
Got
So
it.
those loans typically might take a little bit longer than 30 days, maybe
Mm-hmm.
30, 45 days.
Mm-hmm.
Because you're doing all those components in the midst of your, of your contract. But
Right.
those are some of the ways that you're seeing that, right? It's that you're seeing people, a lot of renovation loans now, a lot of conventional loans. And then you do have a lot of people that are getting seconds. A lot of people are like, look, my first mortgage is it's so low and my rate is so low, I don't want to touch it, but my roof is falling down and I
Right.
need to, I need to fix the roof. So I have had some clients do home equity lines of credit to, to do that because they don't want to touch the first. It's a very case by case.
Mm-hmm.
It's not for everybody. Like, what I mean? Not everything is for everybody. That's why, like, we figure out what it is that you want to do, and we
Right.
figure out, how to steer you in the right direction from there in terms of picking up the correct product.
Okay. And then when someone is selling a property, do you guys suggest against buying a property that has a tenant in it if it's like in a rent controlled area? Like, do you guys deal with that at all?
Yeah, I mean, I have in the past. I've dealt with all of everything of the sun. I manage properties and things of that sort. So, if you want to occupy the property, like, are you buying it to you're eventually going to live in it, or are you going to buy it as an investment for yourself?
Well, my narrow scope right now is some type of multiplex.
Okay,
And
so
so, but looking at that, like when tenants are there with rent control and their
yeah,
amount is very low, do you just kind of steer people away from that, or is it
yeah. I
something?
mean, well, the qualifications typically going to steer you away. So, if
Okay.
the rents are low, then so let's give an example. Let's say you have a 3-unit property, right?
Mm-hmm.
And 1 unit's vacant, you're going to live in that one, and there's 2 units that you have tenants, but the rents are low on those units, right? We get to use 70% of what the rental income is to add into your income. That's probably why you want to buy a multi-unit property, right? Because you get to add some income to help offset the mortgage payment, right?
Right. Right.
Right, right. So if that's lower, then that's lower income that you're going to be qualifying on. So you
Right.
probably wouldn't want it anyways. So
Right.
it wouldn't even necessarily be a thing where we would need to steer you away. It would kind of push
I
itself
wouldn't
away,
qualify. Right.
right? You know what I mean? It might push itself away. And yes, because you don't want to deal with the headache of trying to figure out how to raise the rent or put them out or any of that, unless
Right.
that's negotiated. That's why the team is important, because if we're doing that, Ashley may negotiate that they're going to pay you $30,000 to take this person on, and then you can go through the channels and do it or whatever. Or you can say, hey, I don't
Right.
want to do that, and you do it, and maybe you give
I was gonna
extra
say,
time in the
if it was
contract.
easy, the seller would have already initiated that. So it's much easier to sell a property, multi-units, that's vacant. So the fact that they
Right.
have a market and the rents are still there and they're under market, it's kind of telling. And then outside of how he went through the different was it financing, like 203K and all that,
Mm-hmm.
just kind of knowing, like, okay, for instance, even if it wasn't like multifamily, but let's just say a fixer. If I know my clients, they are in buyers, so they're going to live in this house, they're not investors, I'm not going to show them the house. And now I'll show you whatever you want to see, request it, but I'm not going to suggest going to view a property that's like falling apart, because like you're not an investor, you don't have the skill set for that, you don't have the
Right.
finances. the return can be amazing, yes, but these flippers, they are taking on all that risk. So
Right.
if you bought that house
Mhm.
like unseen, and they didn't know the foundation was falling apart and about to cost $75,000 to fix it, they have to figure it out, and it's going to come up in numbers. But as an end buyer, when I say end buyer, I mean like it's just you, it's your family. You're not doing this for proceeds. Yes, you'll get equity over time, but this is just for you. You're not going to flip it. That's a bigger risk. So I would focus on properties that are within that scope. Not looking at something that's falling apart. What else was I going to mention? He covered how you could finance it. But yeah, I would focus on that. Oh, and then yes, LA homes, they are old. My house, I think it's like 100 years old now. But of course, the listing agents, they should be pricing them accordingly. Like if they're aware of any, roof, big ticket items, roof, foundation, electrical, all those things. So it should be priced accordingly. For me, I focus on homes that are like I always say, like somebody's grandma house that really maintained it. Like it's not cosmetically the cutest, but the bones are good. Like they maintain the roof. There's no water damage, those type of things, because
Right.
that's what costs a lot. The big ticket items. Now the cutesy stuff, putting in the kitchen and countertop, all that, it's costly, but it's not nearly as costly as those things. Because for me, I
Right.
get the house or even if it's units, they got the white countertop. It's older, but it's maintained. It's livable because you can always do those cosmetic upgrades. That's how we ended up doing it because my kitchen when we moved in here, oh my gosh, it was horrible. But the house was good. Like it wasn't falling apart. We just kind of slowly over time did it. But yeah, I would just kind of say and those also things, for the most part, you would know that ahead of time. And if for some reason, like foundation, when you walk in the house, you feel it. You kind of, or if you bring like a pan or a marble, like you're gonna feel it. You're gonna notice it. Roof, usually you can see it. I mean, we're not inspectors. You're gonna get professionals, but for the most part, you're gonna see those things. And then some things you don't know until you get an inspection done. But if you were caught off guard, that's why we have inspections. You can always be like, "Whoa, I was not expecting all this," and you can cancel and walk away or negotiate so that the sellers are going to cover some of those things. But yeah, most things, it's like you would say,